To the investment meeting for September 2014. Let's quickly go around the room, introduce ourselves for the record.
Good morning, everyone. Rosemary DeBellis, representing Police Commissioner Bratton.
Barry Dennis, SIS.
Dan Torelli, PBA.
Joe Alejandro, PBA.
Chris McGrath, PBA.
Lou Turco, LBA. Roy Richter, CBA. Martin Gans,
Scott Evans, Controller's Office.
Susanna Vickers, Controller's Office.
Carolyn Wilpert, Mayor's Office.
Antonio Rodriguez, Finance.
Justin Holmes, Finance. Brian Huck, Controller's Office. Chris Potts, Controller's Office.
Evan Johnson, Controller's Office.
Nicole Jambrizzi, Pension Fund.
Okay, and Mike, just for the record, you have the proxy for the SBA, correct?
Yes.
Okay, very good. With that, we'll turn it over to Scott.
Thanks very much. We are pleased to be here to talk about fiscal 2014, give you the results for the last quarter, which are in your quarterly packet, talk about the market, and then give you reports from each of the asset classes. I've got the heads of the asset classes here with me today. Bottom line, it was a terrific year, 17.74% for fiscal year 2014. Part of a string of very positive years driven primarily by the U.S. equity markets. As soon as I signed on in July, the market started going straight down. And as you can see, in July, the market was down. Martin will tell you it's popped back up in August. But I think what we've seen over the past month or two is kind of indicative of what we can expect. The 17.74, I can't emphasize it enough, is not normal. It's way above what we can expect going forward. We will be extraordinarily lucky to be in the neighborhood of the 7% that's figured in over the next couple of years, and we'll need to sort of reset our expectations and our strategy accordingly. And there'll be more about that when we talk about rebalancing and so forth. I'm going to have Martin take you through the outlook. And then we can discuss as we go forward. So Martin?
Thank you. I have some extra copies of the quarterly report for the fund. Anyone need an extra copy? One more. So, as Scott mentioned, the return for the quarter, as you'll see on page 8, the return for the fiscal year, as you'll see on page 8, was 1774. We also, not only did we have a great year for the Police Pension Fund on an absolute basis, but also on a relative basis, and I'll go through that in a moment. But here's a really good number that I want you to think about. The fiscal year started at about $28.9 billion. The fiscal year ended at about $33.9 billion. So the Police Pension Fund added nearly just short of $5 billion. So that is a fantastic number, in addition to the return. So that's going to help a lot. That's what the bottom line number is. So the quarter was a good quarter, and the year was a good year. What happened in the year? You'll remember about a year ago, at the beginning of the fiscal year, there was a lot of volatility just before the fiscal year started because the Federal Reserve started talking about tapering. That entered our lexicon. The Federal Reserve had been doing quantitative easing, also known as QE, which at the time was up to $85 billion a month in purchases of treasuries and mortgage-backed securities, mostly agency mortgage-backed securities. They started talking about tapering because the economic recovery, according to the data, are showing recovery, and the recovery, while not everyone is feeling the recovery, and we'll show you some charts on that, the data indicates that the recovery is in fact underway. And as a result, the Fed is starting to be less accommodative, and the first step in that was to slow down and eventually stop the asset purchases, because their balance sheet now is, when you buy $85 billion a month, it adds up, it's now $4 trillion. The calendar year of 2013 was a fantastic market for all risky assets, primarily driven because of the Fed's decision, knowing that the markets knowing that there's a backstop that the Fed's backing, and also in Europe with the ECB, and we'll also get back to that in a moment. So the U.S. calendar year Russell 3000 for 2013 returned over 30%, and it's continued to this day. You know, the S&P is now over 2,000 for the first time, so the S&P is at record highs as we speak. The concern, though, that the market had entering the fiscal year was the tapering, that if the Fed is no longer buying all $85 billion, which is a large number of treasuries and agencies, well, supply and demand would indicate that prices would go down and therefore yields would go up. And in fact, that did happen. And yields for the 10-year treasury, which is an important benchmark treasury, hit 3% several times. At the end of the calendar year, halfway through our fiscal year, we were pretty much exactly at 3% on the 10-year. And if you remember, the consensus was that rates will continue to go up. No one knows how much or how long or when, but the expectation was that it would go up as the Fed, supply and demand, stops buying bonds. Interestingly, ever since then, and we'll show you a chart also that we have in the book of the color charts from Bloomberg, that the high of yields occurred at the very first day of the calendar year. 10-year treasury rates have declined in spite of the recovery in the U.S. And while the recovery is slower than prior recoveries, so 2% growth is anemic compared to prior recoveries, nevertheless it is growth. Europe, to compare, the ECB has taken action now to sort of, in their version, duplicate what the Fed's doing on their balance sheet to buy bonds, and that's helping lower yields in Europe, which helps companies lower their cost of capital, which hopefully spurs economic recovery. But Europe is several years behind us. So our data shows that the U.S. economy is improving. And the really interesting thing is that yields on the way up have gone down. And so the 10-year treasury is down to about 250. It was actually in the 230s recently. There's no one consensus as to why that is, but there are several factors. I mentioned supply and demand. So factor number one has to do with supply and demand. I mentioned the demand part because the Fed is no longer buying the securities, so someone has to buy those securities. And if it's not in the strong demand that the Fed was, well, that means prices go down and yields go up. It turns out the federal budget deficit, if you remember going back several years ago, was over $1 trillion. It's now less than half that. Because of that, on the supply side, there are fewer treasuries being issued. So because there's fewer treasuries being issued, it turns out, while still $400 or $500 billion is a huge number, it's still far short of well over $1 trillion. So that has helped support the lower yields. Also, foreign central banks, the data shows, are buying U.S. Treasury bonds. Because the ECB is several years behind the U.S., they're doing asset purchases and other methods of driving down yields to spur the recovery. So, for instance, Italy and Spain, which their credit rating is far below that of the U.S., have similar rates for long rates as the U.S., which is counterintuitive. So investors looking for safety and looking for value see Italy and Spain at similar rates to us and say they'll buy U.S. Treasuries. And then you also have the hot money. The consensus was rates were going to go up, so people sell Treasury futures. When rates go down, they cover that short. That further exacerbates the move in yields downward. At some point, yields will go up. I can't tell you when. We've been saying this for years. But the economic strength ultimately will equal higher yields. When that does happen, the Core Plus 5 will have negative returns or more volatile returns. But this is where we stand from the economic point of view. From macroeconomics, we'll go through the charts a little bit later. It's showing growth. It's showing growth that is less than we would have liked for this point in the cycle of recovery, but nevertheless, it is growth. And so the returns have been fantastic, and what's driven your fantastic returns is your high level of domestic and non-U.S. equity exposure. Non-US equity and emerging markets lagged the US. The US was better returns, as I mentioned, 2013 was 30%, whereas emerging markets were actually negative returns for 2013. And developed markets, ex-US, were below the US, but still very good returns in the low 20s. That has continued in the second half of our fiscal year, and that's why you'll see on page 8, in the left-hand column, the return for the quarter was a very strong 404, and the very next column, the next two columns are the same because the fiscal year to date is the same as the one-year number, is very strong 1774, and it also was well ahead of the benchmark, and we'll go through why. And since the actuary's in the room, the 10-year number is 770, and the 5-year number is 1333, and we're at 10% for 3 years. So the numbers on an absolute basis are very good. The value is just shy of 34 billion as of this fiscal year. So where were we? We're going to go through July in a moment, but where were we at the end of the year? If you turn to page 10, and this is a primary reason why we outperformed the benchmark, as we'll see in a few pages. So the pie chart on the top shows where we're allocated, but the key is where were we underweight and overweight in our rebalancing ranges. And this is an allocation that we've had for about a year and a half now, and it's paid off handsomely because in the last year, equity markets, US equity markets, public markets were the best performing asset that we have. And the worst performing asset classes that we had were Core Plus 5 and TIPS. And if you look at the chart, the overweight in green was the max overweight versus that maximum we could be in our rebalancing ranges. That paid off handsomely, and we'll show you the numbers in a few pages. And the underweights that we have in the middle of the page, in light blue and light purple, are the Core Plus 5 and TIPS respectively. And the underweight, being underweight in the right place and being overweight in the right place has helped, and that's why you have the outperformance that you have on top of the very good returns. So let's go through some of the attribution. So the summary of the attribution is on page 14. On the top half of the page, it shows the allocation effect. To remind you, the allocation effect describes what the effect is of being overweight or underweight policy. And since, as I described, we were overweight US equity and underweight Core Plus 5 and TIPS, those are the main differences. For the quarter, didn't have much of an effect. It was a positive 3 basis points. Every basis point counts, so it did help. But you see from the 12 months, the top line there in the middle on the top is 74 basis points. So 74 of the 76 basis points of outperformance came from being in the right place and avoiding the wrong places. So that bet has paid off very handsomely. And Scott's going to talk a little bit about rebalancing and what we're doing about that going forward. So all three of those, 29 basis points from the overweight in US equity, 34 basis points from the underweight in what's labeled structured, which is the Core Plus 5, and 25 from the underweight in TIPS. Any cash that we had was a drag because cash is basically zero or a little bit above zero. So there was a negative 16 basis points for any cash that we held overall for the year. But the net was a positive 74 basis points. For the 3-year number, it's negative, and that's almost entirely due to the cash. If you remember back in 2011, we held a very high level of cash. That's the negative due to that cash. That'll roll off as we go past this next year. The next section is selection effect. That is describing how managers do versus their benchmarks. So for the quarter, it was a positive 9 basis points. And as you see, there are some positives and some negatives, but nothing major or dramatic, and we're going to go through those pages in a moment. For the 1 year, it was only 2 basis points, and the 3-year was actually minus 59, but both of those are driven primarily by private equity. 2 points, we mentioned this in prior meetings as well. It's the timing differences, public equity just being very well and private equity is lagging, but nevertheless, it's also private equity not doing as well as we expected it to do. So that explains returns. Returns are very good. So how did you do versus other large public funds? And this is a page I think you'll like on page 15, the very next page. When we define this as funds greater than $10 billion. On the left, you see the quarter. Your 404 puts you in the 33rd percentile, and for some reason, don't know why, that 33 keeps recurring. That's a good place to be. It's in the top. It's above medium, just outside the top quartile. If you look at the one-year number, the 1774 placed you in the 33rd percentile. Again, above medium, just outside the top quartile. 3-year number, you're right at the medium, the 1007, and 5-year, again, you're in the 33rd percentile at 1333. So versus your peers, you've done very, very well. So unless you have any questions about how we got where we went and what the environment was in the quarter of the year, I'm going to turn it over to my equity colleagues.
If everyone would please turn to page 19 in the book. You see that the total U.S. equity returns were strong for both the quarter and the fiscal year. The police fiscal year return of 25.68% beat the benchmark by 46 basis points, but the quarterly return trailed by 25 basis points. Turning ahead to page 21, small cap active. For the fiscal year, the small cap active composite beat the benchmark by 236 basis points. Next on page 22, we see small cap passive has a shorter track record and is close to the benchmark. Moving on to page 23, mid cap active underperformed by 236 basis points. And on page 24, we see that for the fiscal year, the mid-cap active beat the benchmark by a healthy 376 basis points. On page 25, mid-cap passive was close to the index. And on page 26, we see that for the fiscal year, the Russell 1000 active composite beat the benchmark by 270 basis points. Russell 1000 passive, again, a short track record, very close to the benchmark on page 27. And on page 28, the Russell 3000 passive was close to the benchmark, pretty much over all time periods as expected. And last in U.S. equity, the last slide on page 29, you see that the emerging managers are also very close to the benchmark. Are there any questions on these U.S. equity slides? If not, I'll hand it over to Tatiana for the non-U.S. equity.
If you guys could look at page 31. This goes over our developed markets, which is your EFA portfolio. As Martin mentioned, EFA trailed the U.S. indices, but is still up pretty strongly with the MSCI EFA index up about 23.6%. Your overall program was down slightly against that by about 17 basis points. There's some numbers in there as we had terminated governors for owners and just put in a small cap passive. And so that's only been in for a couple months. That's sort of obfuscating the details. On an active basis, your managers performed about 16 basis points better than the index, and on passive, we're about 33 basis points better than the index. I'm going to go over some manager returns for you because it's more important here in the EFA section, as we're 90% active. So the greatest contributor, probably one of our best performers, was Acadian Small Cap. You hired them in 2012 during our new search, and they were up versus their index about 520 basis points. Our biggest detractors were, the largest was Thornburg, and we'll talk more about them during our executive session. It was down 940 basis points versus the index. And also Walter Scott, a new manager for you, but we'll discuss again. They were down around 760 basis points for the fiscal year. We'll talk about them in executive session. Moving on to page 38, sort of gives you an illustration of how emerging markets have done. As Martin mentioned, in 2013, emerging markets were particularly challenging based on fears about Chinese growth. As the first half of 2014 continued, you actually saw the markets in EM start to rebound. That's why for fiscal year ending in June, we have the EM index increased by 14.3%. Your overall portfolio beat the index by about 304 basis points, and that was primarily driven by an active outperformance of 407 basis points. The driver primarily of that active performance was Bailey Gifford. They were up almost 900 basis points for the fiscal year. Out of the other three managers, which are DFA, Eaton Vance, and Acadian, none of them underperformed. They were both all up around the 200 basis point. And if you keep in mind, 74% of your EM portfolio is active, so that's why we focus on that. So if there are any questions, turn it over to Martin again.
Thank you. Please turn to page 42. On this page, there is a pie chart that shows where the dollars for fixed income are allocated. We're exactly at $10 billion, just shy of 30% of the total fund. The largest piece in dark blue is shown is the Core Plus 5. So if you turn to the next page, you'll see a breakdown of the Core Plus 5 program. We are underweight the Core Plus 5 as we have been for some time. We've been underweight for a number of reasons. It's a low yielding world, and the duration is very high. So while we're talking about rates rising, and it hasn't risen, but when rates do rise, the way the math works is you will lose money in the portfolio. And we saw that the second half of last year when we had negative returns in the program. So this slide on page 43, a couple of important points to make. Take a look at the under-overweights. So there are three main sectors, and this has been going on for probably nearly 2 years. We're underweight the government sector labeled Treasury Agency. That's the blue, smallest sector. And we're overweight the spread sectors, meaning the other sectors, most notably the investment grade credit sector because of the higher yield. But if you look at the index or the actual return, the next column's to the right, it turns out that because rates went down in the quarter, the government sector had the best returns, although the returns are very close for all the sectors. The good news is that despite that, if you take a look at the very last column on the right, the difference, each of the sectors have outperformed their benchmark. And in fact, for the quarter, of the 15 managers, only 3 underperformed. For the 1 year period of the 15 managers, if you look at the appendix, one manager underperformed, that's Privest. It turns out they actually did underperform. Privest, if you remember, they're direct lending private loans, private placements. Because there's a timing difference, the returns are shown through March, but the returns through June are actually outperforming, so 15 out of 15 managers have outperformed, which is a little bit unusual because with the market participants not showing much differentiation in the returns, managers need volatility, ideally, to differentiate between, to get in good entry points in and differentiate between credits. So with the market not showing much differentiation, it's actually quite a remarkable result that 15 out of 15 have outperformed. Obviously to varying degrees, but it's very good. And the bottom line is shown on the next page. The program results are on the next page. I can't compete with equity returns. On the left, the return was positive, 278 ahead of the benchmark by 18 basis points. For the year, the return was 635, 81 basis points ahead. I've mentioned this in previous meetings. For an asset class that we expect to have either negative returns going forward or very low positive returns, outperformance is very important. And the managers have done very, very well. And the returns going out the longer periods of time have similar returns in the 5 and 6% ranges, outperforming the benchmarks as well. I want to point out something on the bottom as well. The volatility is shown on the bottom in terms of standard deviation. The actual volatility, daily volatility, brought out to 3, 5, and 10 years. If you look at the 3 and 5 year numbers, it's in the 3% range, mid threes. So returns you're getting are for 3 years were over 5%, for 5 years were over 6.5%. Not only are they ahead of the benchmark, but it's really slow and steady returns. So it's been extremely low volatility. The reason I'm mentioning this is because it's good news, but also, not that I wouldn't mention bad news, but it's good news. But going forward, you should not expect this. When rates go up, there will be additional volatility. We saw that in June a year ago. And the volatility will go up. It's not going to go up to equity-like volatility. It'll go up from 3% to another % or 2. Barry can give you more precise numbers. But historically, we look back, it adds another % or 2 in volatility. So it's still very low volatility and has diversification benefits. But we are underweight this because of the low yield. There is no good scenario. If yields go down, there's a limit to how far further down they can go. Secondly, and if they go down, you get a capital appreciation. But all you're doing is stealing returns from the future, because eventually when rates go up, you're going to lose the money. If rates go nowhere, you're stuck earning the low anemic yields, which are in the 2s, which doesn't, the math doesn't help get you to 7%. So we are underweight the sector, and we'll talk more about rebalancing going forward. But the program's done very well. As a whole, the managers have done very well, as we expected. Next page is Progress, which is much smaller. They're a fund-to-fund manager, emerging managers, and they've done very well. The one-year number is over 100 basis points ahead of their benchmark. TIPS is on the next page, on page 46. TIPS are inflation-linked securities. As you know, we're doing a search now. It's out. We'll have the search results for you, hopefully before the end of the year, certainly before the end of the year. And the results are modestly ahead of the benchmark for the longer-term periods. And for the quarter was behind by 9 basis points, but positive returns at 372. The 5-year number is shown as 567, 12 basis points ahead. Net of fees, even though it sounds very low, net of fees, because we pay very low fees, it's still ahead of the benchmark. High yield. This is a very interesting page on page 47. We call it an enhanced yield, which I think these days make a lot more sense because it's no longer high, or you have to be high to call it high yield historically. I'm not saying we are. I'm simply saying historically it is higher yield. It's not really high yield. That's why we call it enhanced yield. However, the returns were very, very good. If you look at the quarter, very good quarter on an absolute and relative basis. The one-year number was 1246, over 150 basis points ahead. We have 7 managers in this.
Sorry, I had this off. My apologies, Mark.
Maybe he doesn't want me to talk about the high yield. So we're over 150 basis points ahead. We have 7 managers in the program. It's remarkable how this worked out. Remember, we hired the new pool of managers, existing managers, back in 2012 using the new process. So we have aggressive managers and we have defensive managers. So you would expect this is a bull market, the most aggressive managers doing well, and the most defensive managers trailing. It turns out that's precisely what's happened. So our most aggressive managers have done the best. Our core managers have outperformed as well, because core managers should be able to rotate into lower quality during bull markets. And we have our 2 most defensive managers have underperformed, which is actually what we expect. If defensive managers outperformed in a bull market, actually that would raise concerns, because it means they're doing something we were not expecting them to do. Overall, though, the returns are fantastic. The returns on an absolute basis are 1246, and versus the benchmark for the year are over 150 basis points ahead. And long-term results are positive on both absolute and relative basis as well. There's 4% of the fund in high yield. We also have bank loans. This is a relatively new chart because it's a new program. And this has also worked out according to what we expect. Bank loans, because they're higher on the capital structure, you would expect lower returns than you would expect from high yield, but you expect lower volatility. So we're getting lower volatility and we're getting slightly lower returns, but they're steadier returns because you're higher in the capital structure. For the one-year period, we returned 635 versus the 12% benchmark was in the 10s for high yield. So the 3 managers, similar to high yield, the most aggressive managers did best, and the most defensive manager trailed, which is what we expect in this environment. Convertible bonds is on the next page. We have a custom benchmark. Just to remind you what the custom benchmark is, that's in light blue. The custom benchmark is simply the weighted average of each manager's individual benchmark. If you remember, each manager has a slightly different benchmark because they fish in a different pond within convertible bonds. The gray bar is an overall benchmark that no one is actually managing to, that over a market cycle will make more sense. So the managers have outperformed their custom benchmark because they've outperformed their individual benchmarks. They have underperformed the overall benchmark. Now I'm not hoping markets go down, but when the cycle completes, when equity markets go down, and they have on individual months, they outperform that overall benchmark. In fact, we saw when we funded the program in 2008, they outperformed that benchmark as well. So that benchmark will be more meaningful in a full cycle. We have not been in a full cycle because it's been pretty much straight up in 5 years. This also returns on an absolute basis. You can't see because of the scale. The returns are quite high for the 1 year, over 17%, which is what we expect. We expect in this program to be 70% of the upside, 70% of the returns of the equity market with 40% of the volatility, and that's what we receive. So the program has worked. We are a little bit underweight this program for now, as you know, because of a manager termination that occurred recently. Opportunistic fixed income is on the next page, and this last thing I'll talk about before I turn it over to ETIs, unless you have questions, is on page 50. The program, as you know, I don't know what the right word is, inflection point. You see the returns are very good. It's the best returns we have long-term in the program, and it is a growing program. So the dollars in the ground are approximately 2%. We're about 2/3 to 3/4 committed. We'll have an annual plan for you. We'll go through in better detail. The longer-term results aren't as meaningful because a lot of the older funds are no longer with us, and we rebuilt the program in a way that the returns will be more meaningful going forward. However, in the meantime, the returns are great. They're just very good returns, and the primary benchmark is 10% return. Secondary is the global benchmark plus a premium. So unless there are questions, I'm going to turn it over to Brian for ETI.
All right, so starting on page 51, we have the overall ETI report. I'm really happy to say everything is up. On the quarterly basis, we are up 84 basis points, and over the last fiscal year, we're up 313 basis points for our blended benchmark. And you'll notice that's above the 7.81%, which I have to say, you know, we're meeting our portion while providing some good work. I will note there is one investment we do have that is currently missed its benchmark. This was in our long-term loan program. The Bank of America on a fiscal year basis under the old PPAR program is below its benchmark. Everything else is above, both on a quarterly basis and a fiscal year basis, including Bank of America. And Bank of America is up under the new program. Switching, if you will, to this lovely book. Running through our investments, starting on page 7 and 8. We start with the PPAR program. Over the last quarter, we've outperformed our benchmark by 113 basis points, and we're 792 basis points up over the last fiscal year. I will note this is partly due to a large uptick we had on the December quarterly right as I started. I'd love it if you would give me credit, though I do not deserve it. Part of that comes from switching from the previous custodial bank to State Street. When that switch happened, our loans got reevaluated, and many of them were considered worth more on a mark-to-market basis. In the second quarter, Police purchased $1.2 million in loans, and that will create or preserve 120 units. In the second quarter, we also made 6.7 rate lock commitments for future loans of upwards, which will produce upwards of 726 units. And that will put our total outstanding commitments right now at about 7,422 units to be created or preserved. Going to the next page, page 9, AFLO-CIO HIT, which is our mutual fund, is outperformed its benchmark by 36 basis points in the second quarter and 8 basis points over the last fiscal year. So far, it's invested $450 million to produce about 10,000 housing units. And since inception, then that's the multifamily. Since inception, HIT Home has done $3 billion of investment for 21,000 units. Page 10, AFLO-CIO HIT, the Workforce Housing Program. This is an initiative that's invested primarily in Penn South here in Manhattan. It's We have 45 million in supplemental Fannie Mae securities, and that is $272 million for 7,656 units. Having trouble speaking today. And last, on page 11, Access Strategies, which participates in the secondary market, buying securities, Fannie, Freddie, Ginnie. We are up 79 basis points over for the second quarter, and 84 basis points for the last fiscal year. To date, we've invested $10 million in 237 single-family homes, $1 million impacting 111 units in multifamily homes. And since inception, police has $104 million in this program, which will create or preserve 33,882 units of housing.
Just have a couple of questions. I know you're not completely prepared for some of these, so I'll understand if you don't have. When we do workforce housing, do they document the employment of the person who's applying for the loan? In other words, this is a police officer, this is a teacher, this is whatever?
Most of we did a 5-year look back to try and understand whether or not we were getting money from the city to try and get to some of this information. And primarily we looked at the long-term loan program, which we have the most amount of control over. We found that it was almost all our loans, I think, right, Chris? Well over 95%. Had some amount of city money into it. We do know that if there is city money going into a program, they put a 5% preference for city employees on any time that HPD does affordable housing.
So in that 5%, they break out, for example, this is a police officer, this is a teacher?
From that point, they do not in any reportable way right now. And there's also some difficulty of us attaining that information as a lender, because we would be, in some sense, potentially tracking other characteristics that might put some liability on us. We're looking at how much we can track and how deep we can get on all of this information, though.
So overall, the entire program, across all 5 systems, how much is actually in this type of?
Right now we have $2.4 billion out in the market right now, including the real assets that Avon's doing with the Sandy work.
So out of the $2.4 billion, approximately 5% of that? Is that what we're talking about?
That's the preference that would be put towards city employees. That being said, because the way the HPD works all of its programs, they don't create absolutes, they create these preferences. So it's very possible that while it's a 5% towards city employees, the programs are being occupied 50, 60, 70% by city employees if they're applying. It is similarly if there's a 50% preference towards neighborhoods, but if no one from that neighborhood applies, it's going to be 0% if a lot more goes up. Absent those, the agency's actually starting to track that information a little better. It's hard for us to keep track of it.
Okay. That's it for now. If I have any others, I'll follow up.
Wonderful. Thank you.
Thank you.
Private equity is up next.
Morning, everyone. So I'm working out of the large board book, page 27. And for an overview of the quarter ending 3/31/2014 private equity performance, what's important on this page is the column March 31st, showing the quarter ended. I think what's important here is the $4 billion in active commitment to private equity that you have. This represents roughly 100 managers which is about 156 fund investments. This represents a market value of about $2.1 billion and unfunded commitment of about $1.3 billion, resulting in a total exposure to the private equity asset class of about $3.4 billion. You'll notice that you made one commitment to private equity over that quarter. That was to the secondary manager, Lexington Partners, for $80 million. Subsequent to the quarter, you were very active in the private equity asset class, making commitments to 4 managers across 6 different platforms. You made a commitment to AXA secondary manager, now known as Ardian, to Crestview Partners, and to, subsequent to the fiscal year ending, to Vista Equity Partners. I think what's important also on page 27 is to look at the bottom. You'll notice your since inception return. That since inception return is for the total portfolio. It's 10.6% IRR and a total value multiple of about 1.37 times your money. If you turn to page 29, you'll see a breakdown of that overall performance. You'll notice that 10.6%, how does it compare to your overall benchmark? This is your benchmark with to the private equity market or to the public markets with a 300 basis points premium. You're slightly below at about 2 percentage points. But I think what's also very important here is the 10-year number or the 10-year returns, which is essentially a good return to look at for the private equity asset class. There you're at about 11.1% and slightly below your benchmark with a premium of about 1.8%. And if you look at your 1-year return, you're also significantly better at about 17%. If you look across the page back to 28, you'll notice why this performance is improving when you look at the earlier vintages. You'll see that when you look at the performance by vintage year, that the returns for the most recent vintage years, even though these are early, they're consistent. They're starting to outperform the overall private equity benchmarks. And starting at roughly around 2008, 2009, you'll see consistent, strong performance, which shows that the portfolio is definitely on the right track. Turning back to page 29, you'll notice what are some of the key drivers of your overall performance. I think some of the key areas to highlight here on the bottom, the subsectors that are really performing well for private equity are the large buyout platform, which includes managers such as Apollo, the growth equity platform, which includes managers, recent commitments, so forth, to Vista Equity Partners, and overall the secondary platform, including Ardian, Landmark, and so forth. Turning to page 31, you'll notice the diversification across various strategies and geographies. The program is very diversified. It's trending in the right direction. You'll notice that the outweighed area as far as strategy is to buyout. That's at about 60%, which is right in line with your benchmark of about 60 to 65%. The overall geography diversification is still heavily skewed towards North America, but with a trend towards rest of the world and to the global sector. So once again, portfolio heading in the right direction. If you turn to page 33, I think that's one of the key highlights of your overall portfolio. And what you'll notice here is a trend line for your quarterly cash flows moving upwards. And what that means is your overall distributions are outweighing your contributions. So what you have is essentially a self-funding portfolio, which is the right trend you want in private equity. And if you look at the next page, you'll notice that this trend line is moving nicely across various yearly cash flow cycles. So overall, good performance for the private equity asset class. Any questions?
Thanks, Rafiq. We'll move to Yvonne in real estate.
So real estate in the same book, the cover page is 43.
The following pages that follow, I'll probably refer to the page numbers at the bottom since the other page numbers are obscured. So I'm going to talk just briefly about investment activity over the past 12 months. You know, Alternatives has a quarter lag, so unfortunately I can't give you a fiscal view, meaning as of 6/30, but certainly I can give you the past 12 months ending 3/31/14. And there's been activity in real estate. It's been very strong for the police portfolio. We were able to execute 5 new investments for a total of $343 million in commitments. And what's interesting about that number is there is about $25 million that we've set aside for co-investments. What's also interesting about those 5 investments is that 3 of them are actually with existing managers. And so, as you know, this is a recurring theme at BAM to find best-in-class managers to be able to expand that relationship and hopefully, as a side benefit besides performance, also be able to derive some fee savings, which we were also able to do this year with those new transactions. In terms of performance, the performance for real estate for the past 12 months for police was 16.6%, very strong. The benchmark, which you know is Odyssey plus 100, in recognition of the fact that we have a blended portfolio of core and non-core strategies, that benchmark was 13.9 for the same period. So very strong outperformance of 330 basis points. Now I'm going to turn my attention just for the portfolio review for real estate in the board book, which again follows after page 43. Real estate is part of the real asset category that has a 6% allocation by the police system, and the allocation right at that point is $2 billion. In terms of the value of the real estate in the ground for the police portfolio is $1.2 billion. We're very active, as you know, and we have about $534 million in commitments that we have yet to fund. So in terms of the exposure to real estate for the police system, it equates to about $1.7 billion. We have 50 investments at this point with about 36 managers. Those 36 managers are busy globally putting together a global portfolio of core and non-core strategies. The portfolio, as you know, we try to be responsive to what's going on in the market. So right after the financial crisis, we focused on non-core strategies with managers who had the expertise to be able to fix broken assets, to fix capital structures. And right now, if we kind of look at how the portfolio is balanced, it's skewed toward non-core right now at 69% and 31% core. You know, we typically like to maintain a minimal level of 40%, but over time, we believe that that's going to normalize. In terms of performance for other periods, if you look at the bottom of the page down toward the right, we were pretty much evenly matched for the quarter at 2.5%, and all this information is net of fees. We talked about the 12-month performance at 16.6. The 3-year performance, again, a very strong 14.1, 100 basis points ahead of the benchmark. We see things starting to get a little mixed up as we look at longer periods. And historically, if I kind of look at the police portfolio, you might recall that 2007, there was a large number of commitments that we made. And quite honestly, it was $394 million. Some of those managers displayed the discipline and held back as things started to implode, and then some didn't. And so we're starting to, we're seeing the result of that on a net basis. But the most important thing is that we've refined our manager selection process. Post 2011 and all those vintages, we've already seen it bear fruit in the 1-year and the 3-year performance that we're moving in the right direction in terms of the managers that we're working with, both large and small. And so in terms of diversification, if you turn to page 5 at the bottom, you'll see how we try to mitigate the risk of the portfolio in terms of property type and in terms of geography. I guess I would point out down at the bottom, internationally, we're at 13%. In terms of where we'd like to see ourselves as a global real estate program, the IPS set a goal for 25%, and we're trying to move along toward that goal. I forgot to mention that if you were interested in understanding which of your managers were actually driving the returns, just hearkening back to returns again, you'll see on page 4 an attribution analysis that shows you who's driving and who's detracting from your return. Now, this is a snapshot of the quarter. I remind you that, real estate is a long-term asset class, so, a quarter is really just a blip. But it's a great illustration of who's driving the performance and who's not, and to also harken back to a comment that Martin made, that just because they're at the bottom, we made conscious decisions to place capital with managers that employ defensive strategies. So that's also a consideration you can make when you're looking at an analysis such as this. You'll find another one in the back that talks about the 1 year and the 3 year. And just to sum up, on page 7, there's a table that talks about the risk characteristics of the portfolio and whether or not we're in compliance. From a performance basis, as you can see, as we reviewed the first page, our near-term performance results are very strong, and not so much for the 5-year. So on a market cycle, we are striving to bring the program above the program benchmark on a 10-year basis. And we talked about very much all the other characteristics here in terms of the portfolio construction, diversification, leverage. We're within our bounds. Leverage is at 41%. You know that this was very much the culprit during the crisis, and the program benchmark is 65%. So we're substantially in compliance with the program according to the IPS. So if there's any questions in particular about real estate, I can address it or turn it over to Petya, who's the other half of real assets.
Good morning. This is the first performance report for infrastructure. We're excited to be here with this first report. As you would recall, we started investing in infrastructure a year ago. During that year, we invested with 3 best-of-class managers in core strategies. Core strategies as defined by the IPS, which includes core and value-added strategies. At the end of the first quarter of the last fiscal year, the infrastructure portfolio was funded at $18 million, and 152 of unfunded commitments are outstanding. This is because the portfolio is still at a very early stage of development. The managers are allocating capital, they are active, but as you know, there is a 5-year period over which they invest, so it's going to take a while for them to invest the commitments. Again, we are at a very early stage of the portfolio, so the performance results are not very meaningful, and they're just a point in time, just quarterly. But what we're seeing so far is a gross return of around 12% and a net return around 9%. This concludes my comments. They're short. We have a small portfolio so far. We would be working towards enlarging that. If there are no further questions.
Yeah, I'm just going to cover hedge funds quickly. If you go to page 40, you can see the hedge fund returns. The hedge fund team has been in the process of putting the program in place over the past few months. And what you see in the results are not a full program. In other words, they're just pieces of a full balanced program. When you break the components out, which I don't think you can do from this chart, you get good comparisons. But as you can see, in the trailing 3 months, our hedge fund portfolio is up 2.27% versus the benchmark at 1.72. Over the fiscal year and trailing 12, it was below the peer group HFRI fund of funds composite, but comfortably above over the past year the Treasury bill plus 4. In other words, taking into account the extra risks that we have in pension or in hedge funds, we use a T-bills plus 4% benchmark, and it's cleared that bogey. If there are not any questions on hedge funds, we will turn to Martin and I'll talk a little bit about the dynamics over the month of July, particularly rebalancing. Okay. Martin, why don't you talk about the environment and I'll talk about the rebalancing.
On this book here, with the color pictures, we definitely have extras if anyone needs. Good? Okay. So I'm not going to repeat myself as I'm often accused of, but because we went through a lot of this in June. But most of these charts show an improving economic situation in the U.S., but it's been mixed and it has not been as strong as one would expect. Page I want to show is page 6, consumer sentiment. One of the major studies is done by the University of Michigan. If you take a look at the 5-year number, it looks like it's gone up at 79.2. And I will tell you that historically, at this point in a cycle, in a recovery, the number should be well above that. So what this means is that people, when they're surveyed, they're not feeling the recovery. They're not feeling the recovery, and part of that has to do with the unemployment rate, which is the page before. Page before says 6.2. A recent number just came out, which is near that, which is definitely an improvement. As you see, it's continually improving. As it was near 10%, actually it was 10% 5 years ago. The problem is the number that we use here from the Department of Labor is the headline number. It's known as U-2. There are different measures of it, and one of the primary problems is it does not include discouraged workers. It does not include a number of other workers that, if you did include them, the numbers would actually be in the low double digits. And that's why people don't feel the recovery yet, because it has not impacted many people. Wages have been stagnant, as you've been reading, and it has not fully been impacted by or felt by everyone, which is why one of the reasons why the Fed has continued doing what they're doing in the face of what appears to be recovery. I'm going to turn now to the second half of this book. I want to show you a page 18. This is the VIX, Volatility Index. It was in the 11s. I can tell you right now, as of, I believe, yesterday, it was about 13, which is roughly the same. Historically low. When it goes low, it means that investors are effectively not buying puts to protect their investments because they think the market's going to keep going up. So when these numbers are low numbers, it means that the market's very complacent, and investors think that the market will keep going up. When the volatility index is higher, it means it's usually because the market's going down, there's a lot of volatility. So what this is saying right now is that investors see things as quite calm. Generally, that means is because investors are usually, it's a very good contrary indicator. When the VIX is low, it means can't know when, but it usually means there's some sort of correction coming. Don't know when, don't know how much, and vice versa when it's high. It usually means that's the time to buy. Another page is the 10-year Treasury on page 20. I keep mentioning that here. It was about 240. It says 239.9. It's about 250 this morning. As you see, towards the right of this chart, the double high there were every time we hit 3% late last year, we bounced right off of it, including at the end of the year when everyone was expecting that it would go higher. Next page show high yield and investment grade spreads. They are very tight. What that means is that investors are willing to pay up for high yield bonds, regardless of the fact that they are riskier because investors are in search of yield. In the US, if you take a look at page 23, comparing, there's 3 charts there showing the US, then the developed markets and the emerging markets. The US on a PE basis is more expensive. It's fairly valued and arguably overvalued depending on different metrics. But the non-US equity markets have a ways to go because they're behind the US, especially in the emerging markets. And the next page, on page 24, breaks down the US into large cap, mid cap, and small cap. And what this basically says is that small cap has run a lot and that it is more fairly priced or overpriced than large cap or mid cap. The next page, page 25, just shows you what's happened over the past year through the date that we ran this chart, which was about a week ago. And the white line is the US, and basically it's pretty clear, and numbers are on top. The US has outperformed quite nicely the developed markets and emerging markets by about 10%. The US last 12 months is nearly 22%. On page, so how did we do in July? Page 27 shows, page 27 and 28, if you look all the way on the left, July was the first month of the fiscal year, so 1 month means a lot here. And it will be the same number as a fiscal date, year-to-date fiscal YTD column. It was all negative because at the end of the month the market went down, there was more volatility. I have put in front of everyone's spot, there should be a page that shows what August numbers were. August undid this because, as I mentioned earlier when I was going through the quarterly, there were record highs reached on certain indexes, and that was during the month of August. In fact, if you look at the July number, the Russell 3000 was down 1.97%, but in August was up 4.2% just in a single month. This extends to virtually most other asset classes. EFA was roughly flat, down 15 basis points, but it's hard to find a negative number on the page for August. Because of that, for the 2-month period, again, this is an estimate, we believe, while this shows that we're at a negative number, in fact, if you turn to page 29 with the bars, all the way on the left, the 1-month number, which is the first month of the fiscal year, we were down 111 for the fiscal year. For when you include August, which we don't have official numbers yet, but we have done some calculations, because August was such a good month, it undid the 111 and then some, so that the 2-month number, which you'll see next month, should now show a positive number, approximately being about a positive 1%, in the positive 1% range. So it was a very good August. Where are we focused? So Scott was just mentioning about rebalancing. You see the same overweight, or not similar, same overweight. It's a little bit less of an overweight to U.S. equity that's shown in green on page 30 on the left. And in the mid, you see the underweight to core fixed income and TIPS. And I'll turn it over to Scott.
So it may be worthwhile, as I talk through the slide on page 30 of the flip chart book, to go to the quarterly at the same time and look at page 10. It's the same chart, but for the end of June. And what these charts show, page 10 for the end of June snapshot, and page 30 on the flip chart for a snapshot at the end of July, is where do we stand relative to the policy that you all have worked out with the help of Barry and with BAM over time in terms of how do we want to structure the portfolio in all the asset classes. A zero across this line would be we're exactly in line with what we hope to be, adjusting for the fact that we park money in equities if we can't invest it in hedge funds or private equity. And so if we had zeros all across, we'd be exactly in line with the policy. We've been a little overweight, in fact a lot overweight equities in this portfolio for a while. You can see 4% or 400 basis points overweight the green at the end of June That's US equities, and just slightly overweight the international equities. And very underweight long-term bonds, the light blue, 330 basis points. Those little brackets are the range that we have to travel in before we exceed the policy. So you can see we're right at the upper end of being overweight equities and right at the lower end of being underweight bonds. So it's sort of the maximum aggressiveness that we can have the portfolio going into this. This has worked extremely well over the past year or two, and it's been a pretty constant policy. But as Martin just outlined as he went through the slides, this recovery in equities versus bonds is long in the tooth. We're no longer getting paid to take the risks that we take in equities, in long bonds versus short bonds, in bonds with credit risk versus bonds without credit risk. And Martin showed you that on all the charts. So we're now at a time, and we don't jerk all the money and put it under a mattress, but we don't want to be sticking out in terms of our benchmark when we enter such a period. So not abruptly, but slowly we're going to bring things back into balance. And you can see that happening on page 10 at the end of June, 400 basis points overweight equities. And if you look over and look at the July, we're about 2.8% overweight equities. And today we're less, and I'll tell you in the executive session exactly where we are. But since coming in, it's one of the things that I've done is I quickly talked with the team and with Martin, and we decided to put a rebalancing plan in place to get back to your long-term policy over time. We won't be exactly there. It's too costly to constantly be balancing back. We'll let it drift a little bit. But I don't think we're going to revisit the edges of the bands in most asset classes. It's a good policy over long term to rebalance. When you rebalance, you're always buying assets that have underperformed and selling assets that have overperformed. It's the one type of tactical asset allocation that has a terrific track record over time. It's just good policy to keep the portfolio fit over time. So this is the start of a much more regular rebalancing. You'll hear the managers talk about rebalancing within the portfolios as well, and we can discuss this in any level of depth that you like in the executive session. That is it for us for the public session. And if there are no questions, I'll turn the floor back to the chairman.
So we're done? No, we
There's
actually
one more
have
public session item.
Oh, I'm sorry.
variable sub.
What did I miss?
Yeah, we're done, the controller's office is done, but the trustees has suggested
I'm sorry.
a quick discussion with the actuary on the variable.
I believe, was that on the skim, Bob, you sent out, or you discussed that the issue of the skim is become important now, and for the first time in I think you said 18 years, essentially, that there is actually a possible skim to be dealt with here.
Yes, that's true. Although the numbers have yet to be checked and are being finalized in the Controller's office for the total returns for fiscal 14, and the Actuary's office has to allocate it between the officers and the superior officers. And we will be providing you letters and so on and so forth. It looks like there will be a significant transfer of assets from the main fund to the two variable supplement funds this year. I don't want to get anywhere near precise, so I'll round to the nearest billion. But it does look like it could be a transfer of over $2 billion to the two funds combined. So for this year, unlike last year, it's our expected situation that instead of just transferring enough money to meet December's police superior officer payroll, we will suggest to the board a transfer of an amount of money that will be more than that, which obviously will be good to coordinate with the Controller's office and the Bureau of Asset Management over what to do with the money once it moves out of the main fund and into the variable supplements funds. But it does look like a significant skim, and the last time there were transfers of assets on account of excess earnings, quote unquote, was 1996. I'm having to dig out some really old letters to get them all ready to provide you. Finalization of the numbers won't actually occur until almost April of 2016. So you'll see that I'll probably come to this board in a month or so with a suggestion of transferring 90% of a rough estimate, and then it'll all get straightened out after we check everything.
Did you say April 2016 or 15?
16. And the reason is that the allocation component is based on the June 30, 14 data. And the June 30, 14 data is not final until we finalize the June 30, 14 lag actuarial valuations, which are used to determine fiscal year 16 employer contributions. And with all the contracts being changed here and there, what the salaries are going to actually be on June 30th of 2014 is still up in the air, and that is a critical element of determining the allocation between the superiors and the officers. So it will be some time until we finalize the June 30, 2014 valuation, and so the absolute finalization of the transfer will not occur for some time. But in the past, when we've had these situations, as I say, we make rough estimates of what the numbers are, and I've recommended to the boards to transfer 90% and then sort it all out later. And that's usually worked pretty well. If the numbers got refined sufficiently to justify a somewhat greater transfer later, that might be considered. But as I say, finalization will take some time simply because the data isn't available for some time.
And you've got people on your staff that are expert in this skim that can sort of carry the ball with you leaving?
They will be. At the moment, everybody's noticed that I'm the only one that's been around that long to know anything about how to do this. But I've already dug out all the letters, I've marked them up, and I'll be teaching everyone how to deal with it. It's a series of interesting, and no individual part is complicated, but combining all the components together, the calculation of the potential skim by the controller's office, allocating it between the officers and the superiors, testing for what we refer to as the ABO gate, which is a limit on how much could be transferred even if you have a potential skim, which as of a few days ago I actually thought might apply, but I think it's not going to quite make it this year. But we have to do numbers that we haven't done in years before. So all that's being worked on, and we'll have more information over the course of the next couple of months.
So in essence, everything performed even beyond your expectations.
That's absolutely true. I had thought that the deficits had built to such a level that it would take many more years before we were talking about actually transferring any assets. But a couple of years of equities performing at over 20% a year and a few decent years before that, it's done quite a number on the situation. And so we've dug ourselves out of a really deep hole, and looks like this is the year in which transfers are going to occur.
No problem, okay. I'm sure I'll have a comment for you later on.
I would not be surprised. Normally, the way we do this is that we would recommend in either the October or at the latest the November board meeting a 90% of something to create a specific number that then the board would adopt in a resolution, which we will supply you, and the money would transfer shortly thereafter. So at the latest, I would envision this happening with the regular board meeting in November, thereby having the money in place well in advance of the December 15th payments.
And you anticipate being the person that's gonna present that?
Well, that's a date after I'm supposed to be retired, but who knows, maybe I'll show up in October with some suggestions, so. Welcome.
Well, do we also have discussion on the basket clause?
That was on the revised agenda?
That's just an appendices, not a discussion.
Oh, okay, on my
Was
calendar
that-
it says
was-
discussion.
Was that, oh, by the way, the legislation?
I mean,
Okay, if you wanna touch on that? 'cause-
I'd be happy to.
We got the attachment from Barry.
Ah, okay.
Yeah, Barry had a memo, regarding the basket clause and what it might do to our.
And I can be very brief. At July, I was asked to begin looking at this, which we've done.
The possibility for being approved?
Yes, so a 5% potential increase in the basket from 25 to 30. You know, the assumptions have changed since last time, and the fact is that some of the basket eligible asset classes, and I'm talking about non-core real estate and opportunistic fixed income and hedge funds, are only about halfway to their target. So do you want to increase those targets when you're not even halfway there? There's a number of questions we have to work out with Scott. The good news is we can increase portfolio efficiency by taking advantage of this extra leeway. And initial optimizations show that it would be used to create a better balance between the non-US and US equity portfolios, and maybe add a little bit to the private equity portfolio, which is pretty much at its target. So that's really what it's showing.
Yeah, and Barry, this is an exercise, right? So you did an exercise, you highly constrained it because of the assumptions you just made. And as we go forward, we'll do a lot of other exercises to get to just the right mix. But he did verify that if the basket clause is signed, we'll be able to structure a more efficient portfolio, better risk and return balance.
You know, Barry, if I could ask, just for the record, on your August 26th memorandum, where you presented some expected returns and risks.
Yes.
Just the returns you're showing, are they annual arithmetic or are they compound geometric? And
Geometric.
so over what period?
Geometric, and it is 2 complete market cycles, so 10 to 15 years.
Okay, thank you.
I mean, I think we're all really excited to have this discussion, and we're really happy that SIS actually has, taken the initiative to start this conversation. One area that we were thinking, I know we had, back in April 2014, we had put an RFP for emerging market debt, and so, with the going forward exercises, looking if that would change anything within our allocation, within our asset mix. I don't know kind of where that is, but I know during that time period, like system-wide, we put out an RFP for emerging market debt, and knowing that that's going to be a part of our asset mix going forward potentially.
There is a component of emerging market debt in this work.
Okay.
Now, one of the problems with an optimizer is if you show it allocations of 1%, it doesn't handle those little allocations, it gets real confused. But opportunistic fixed income is modeled as 1/3 emerging market debt.
So there'll be a lot more discussion on this if the governor signs the.
That's a big lift right now.
Yeah.
I'd like to say when. Rather than.
So, but it would be great in terms of giving us more flexibility. We have some of the tools that other funds have to be more efficient and forward. Right.
Okay.
We don't do the variable.
Yeah, so we need a motion to leave the public session and go into.
Public session of the pension fund and go into the public session of the police officers.
Police
variable
officers,
supplement.
yes. Second, okay. Actually, we need a roll call, right? PBA,
Here, Joe Alejandro.
Controller's Office,
Here.
Finance,
Here.
and the Mayor's Office.
Here.
We could take Bob Moore to task.
So the only item on the agenda is the quarterly performance. I know that Bob just mentioned that it's likely or possible that there will be significant contributions. As of the date of this report, if you turn to page 3, the fund was a fairly simple fund, which had 2 main programs: U.S. equity that was 100% passively managed, and the Core Plus 5, and some residual cash. That was it. The returns that are shown on page 3 are actually higher than the regular fund. That's because did not have diversification. Helps in a down market. This was an up market, and you had biggest exposure to the best asset class, which was U.S. equity. So the total return for the year was 1840, and for the quarter was 413. It was behind the benchmark, and we'll get to that in a moment. On the very next page, doesn't seem to be numbered, but after page 3 should be page 4, basically shows there are 2 main allocations presently. It's Core Plus 5 structured and U.S. equity. And we've been underweight the U.S. equity and overweight the Core Plus 5. That's been a result of because we make payments once a year, we felt the time to true it up would be the next payment because of the costs involved in doing it, which we will be doing December 15th. And we'll have further conversations about creating a new S allocation once funds come in. That will be after the money comes in, after December 15th, once the payments are in. So the value of the fund is $390. Even if there wasn't a skim, it's well more than enough to pay the benefits. The underperformance was pretty much because of what I talked about. We were overweight Core Plus 5, underweight U.S. equity, and any cash that we held hurt. But overall, the fund did very well, and there's more than enough to pay even without a skim. Are there any questions?
Well, we look forward to a very robust scheme which will provide this benefit for many, many more years to come, given the hard work of the trustees at this table. Okay, so
we need a motion.
Make a motion to leave the public session of Police Officers Variable Supplement Fund. We need to go into there.
Into executive session.
I make a motion to go into executive session for purposes of discussing manager performance and possible transfer of assets.
Second?
You need to exit this to go into public for the main fund, and then from public exit into executive session.
I thought we just did that.
No, he just went to go from executives, from POVSF to executive session. So,
Okay, we'll do it again.
We'll do it again. I thought I did, but, okay, so I make a motion that we go from the Police Officers Variable Supplement Fund public session to the Police Pension Fund public session.
Second.
Now I make a motion to go into executive session of the Police Pension Fund for the purposes of discussing managed performance and possible transfer of assets.
Second.
Okay, 5 minutes to break down the cameras, and Joe, that was